The invisible trick. It's one of the strangest facts of modern life. Every dollar in your bank account, every number on your screen, every payment that passes from one hand to another isn't really there. It's a promise, a claim, a belief in a system that works only because everyone assumes it does. But here, the uncomfortable truth. Most of the money we use dosanti actually exist. It's created, not printed, not minted, but conjured into being through a centuries-old financial sleight of hand known as fractional reserve banking. It's the system that makes your mortgage possible, funds your government's deficits, and powers global trade. But it's also the same system that ensures money is born as debt, that inflation never truly stops, and that those who lend, not those who work, ultimately own the world. So, how did this trick begin? To understand, we need to travel back to a time long before central banks, credit cards, or even paper money, to the days when wealth was measured in gold and trust was everything. The gold of trust. In the bustling marketplaces of medieval Europe, gold was heavy, risky to carry, and easy to steal. So merchants turned to goldsmiths, skilled metalworkers with strong vaults, to keep their treasures safe. In exchange, the goldsmith would issue a receipt, a piece of paper certifying how much gold was deposited. Over time, these receipts became more than proof of storage, they became money themselves. Why carry gold when a goldsmith's note could buy anything? The receipts circulated from hand to hand, backed by the promise that anyone could redeem them for the gold stored in the vault. And here's where the illusion began. The goldsmiths noticed something peculiar. Hardly anyone came to claim their gold. People trusted the paper. And so, temptation crept in. If everyone believed their gold was still there, the goldsmith could theoretically issue more receipts than gold actually held. And he did. He began lending those extra receipts, effectively creating new money that didn't exist before. Borrowers repaid with interest, making the goldsmith richer without mining a single ounce. This was the birth of fractional reserve banking, a system built not on gold but on confidence. And as long as that confidence held, no one noticed the trick. But what started as a clever convenience would soon transform into a machine of credit, risk, and invisible wealth, one powerful enough to shape empires, collapse economies, and redefine what money really means. The birth of modern banking. By the 17th century, the trick had gone public. The first true banks emerged in Amsterdam, Venice, and London, inspired by those goldsmiths. The Bank of England, founded in 1694, perfected the model. The Crown, desperate to fund wars, borrowed heavily from private investors who received government bonds in return. In exchange, the bank gained the right to issue notes far exceeding the gold it held, all backed by government debt. It was an elegant loop. The government borrowed money it didn't have. The bank created that money from nothing. The public accepted it as real currency. Thus, a self-reinforcing cycle was born. Money created as debt, guaranteed by future debt. Over time, paper money became official currency. Central banks emerged to regulate this growing abstraction, promising stability. Yet the foundation remained the same. For every unit of currency in circulation, only a fraction was backed by real reserves, and that fraction kept shrinking. By the 20th century, gold was gone entirely. In 1971, when U.S. President Richard Nixon severed the dollar's final link to gold, the world entered a new era, the fiat system. Now, money wasn't tied to anything tangible. It was whatever governments said it was, numbers on balance sheets created when banks issued loans. Under fractional reserve banking, your mortgage, your car loan, your student debt, all of it actually creates new money when the bank approves it. When you borrow, the bank doesn't transfer existing cash from another account. It types new digits into existence. Your debt becomes new money circulating in the economy. And when you repay the loan, that money disappears. This isn't conspiracy. It's policy confirmed by central banks themselves. The Bank of England openly states when banks make loans, they create money. The system works until it doesn't, because when credit expands faster than productivity, prices rise. When too many promises chase too few goods, inflation eats away at value. And when trust falters, the illusion collapses. The breaking point history is filled with reminders of what happens when the trick loses its magic. In 1929, the Great Depression revealed the danger of overextended credit. Banks had lent far beyond their reserves. When depositors rushed to withdraw, the system imploded. Thousands of banks failed. Millions lost their savings overnight. Governments responded with deposit insurance, central bank bailouts, and stricter reserve rules, all designed to restore confidence. But the system didn't change. It simply evolved. By the early 2000s, credit had again ballooned. Fractional reserve banking, now turbocharged by digital systems and complex derivatives, allowed banks to multiply leverage far beyond what regulators imagined. In 2008, the global financial crisis struck. The collapse of Lehman Brothers exposed the same ancient weakness. Banks had created mountains of money through debt, much of it backed by questionable assets. When the illusion cracked, liquidity vanished almost overnight. Once again, governments intervened. Trillions were created digitally this time to rescue the system. But this rescue came with a cost. Even more debt, even lower interest rates, and a widening gap between those who own assets and those who owe for them. From that point onward, global money supply exploded. By 2024, the world's total debt, government, corporate, and household, surpassed $300 trillion. That's more than 3 times the value of everything humanity produces in a year. And yet, the same mechanism that caused the problem is still considered essential. Without continuous borrowing, economies stall. Without new debt, money creation stops. We VA built a system where growth requires more promises, and where those promises can never all be fulfilled. The illusion and the exit here, the paradox. The entire financial system depends on something that can physically exist. If every depositor demanded their money today, the banks could repay only a fraction. The rest exists only as digital entries, debt owed by someone else. This is not corruption, it's design. The banking system was built to transform trust into liquidity, debt into money, and belief into value. And so long as people believe in the system, that their deposits are safe, that governments will backstop crises, that tomorrow will be richer than today, the illusion holds. But cracks are widening. Inflation quietly erodes savings. Asset prices detach from reality. Wealth concentrates among those closest to the source of money creation: banks, corporations, and governments, while ordinary savers see their purchasing power decline year after year. The modern world runs on synthetic prosperity. Money is no longer a store of value. It's a claim on future labor, productivity, and confidence. So, where does real wealth come from now? Not from chasing numbers on screens, but from owning things that the system cannot easily create or devalue. Land and property, because no algorithm can print soil. Skills and knowledge, because no inflation can erase competence. Relationships and reputation, because trust, the original currency, remains priceless. True financial independence means seeing the system for what it is, not rejecting it, but navigating it with awareness. Use debt wisely. Save intangible value. And never forget that money is not wealth. It's a mirror of belief. If history teaches one lesson, it's this: every monetary system built on confidence eventually faces a reckoning. But those who understand how it works don't fear the collapse. So next time you see a bank statement, a digital balance, or a $1 trillion bailout, remember, you're not looking at money. You're looking at promises, and promises, like trust, last only as long as people believe. 3 takeaways. 1. Money is created through debt, not savings. Every loan expands the supply. 2. Fractional reserve banking is a confidence game. It works only if withdrawals remain small. 3. True wealth is tangible, and independent skills, assets, and self-reliance outlast paper promises. Final thought: the system won't end with a bang, but with disbelief. When people finally ask, "What is money, really?" the world will begin to rediscover value, not as a number, but as something real. If you found this breakdown eye-opening, share it with someone who's never questioned how money is made. Because the first step to financial freedom is seeing the illusion for what it is.